Gives me a great pleasure to bring on board Sumeet Nagar, Managing Director with Malabar Investments, right here in our studio almost after 3 years. So nice to see you in person.
Yeah, good to see you in person too.
It's a market where in this 1 year, I guess we've seen it all. A lot of euphoria in the month of Jan, a lot of realization, I guess, in the month of March, and absolute fear in the month of June. Markets are back on track. But even the bulls are back. Are they here to stay?
Well, that time will tell. I think the cycles in market are given, right? I think it's just a question of how you respond to it, right? There's points in time when people get very excited, very optimistic, as we saw towards the end of last year, beginning of this year. And then some rationalization sort of comes in, and then sort of pendulum swings a little bit the other way, right? Which is what we saw a little bit earlier this year. I think, you're seeing some rebound in the market. Too early to tell if we have reached the bottom. I think, as you said, as a winter is coming, and this time it has an added meaning in terms of what happens in Europe. So we'll see where it evolves. But I think you're starting to see more opportunities in this market where earnings are strong, businesses are doing well, but the markets and valuations have cooled off a bit. So that's a good hunting ground.
So there is a time to sow and there's a time to reap in the market. At the current juncture, are you reaping or are you sowing?
I think we've started to sow a little bit,
Okay.
right? I think towards the end of last year was the time to reap. I think we saw 2 very strong years of performance, both 2020 and 2021 were very strong performance. While in the backdrop, you still had an economy that was heavily impacted because of COVID, right? And despite that, the markets gave a very strong performance, obviously from a very low point in the beginning of 2020. But usually in that environment, you find that things get ahead of themselves. And that was a time to really reap the benefits. And coming into this year, when apart from the normal economic or market cycles, you had this added jolt of the conflict in Europe, which had a very different impact on commodity than what a normal market cycle would have meant. And I think in that environment, you need to reassess. In some places, you need to take the profits off the table. But I think, as I said, over the last 8 odd months, you've seen earnings continue to grow in many companies, and the market prices have cooled off. So this is a good environment to sow.
I'm going to take the clock back and talk about what you had invested in. Big call in iShare. It was a big position in Mayur Unicoater, if my memory serves me right, Web of Gems, Chola. What have you done with some of your large original big holdings? Haven't spoken to you in a while actually, so I won't revisit that.
Yeah, so I think some of these positions, these are all very good companies. So let me start off by saying that.
You exited all your old heroes, which are iShare, Mayur, Unicators, or Web.
Yeah, so those iShare and Mayur, we did exit for different reasons. But the main point is that, from a prospective basis, are they able to generate us the kind of returns that they've done in the past, or what we're able to find in other positions? And the answer was probably no. In case of Wabo, we have. So just like I was saying, Wabo did extremely well during the pandemic, right? They had supreme outperformance in terms of their earnings, and as a result, in terms of market performance. But then the price got a little bit ahead of this itself. So we actually, a good part of last year, we trimmed the position. But then, they decided to expand into the German market, which is a great thing, right? It's a way for them to invest in the business, to expand their addressable market. And it coincided with e-commerce sort of slowing down, from a very strong year, right? But if you look at the year-on-year numbers, they're soft. On top of that, you have this expansion, which sort of brings in cost. And in this business, you invest through OPEX, not through CAPEX. And so it hits your P&L right away. And so as a result, the market has treated it very poorly. So it's got
1,000 rupee stock has become a 300
rupee stock.
You still own it?
Well, we own it and we want to add more to it, right? Because it's a fundamentally sound business. They were investing in it for the future, and that's why they expanded their operations. They've, went into Germany, which sort of, grows their market, and it's at 1/3 of the price.
You've historically run a portfolio which was very largely tilted towards financials. Are you still running that high weightage? Names may have changed, but is the weightage still high in financials?
So I would say that we're not particularly amorous towards one sectors. We
So it's
we
not
look
like a
for value.
35% benchmark you have to
No,
follow.
so we don't have to. We're okay to have 0% allocation to financials, right?
Okay.
But financial is an area where we see a lot of opportunities going ahead, and that's why we invest in companies. But it's very bottom up, right? And yes, the names may have changed, but I think for the last several years, one of our biggest investment in financials has been Aptus Value Housing Finance, and it's a business that we're very, very excited about. It's actually been, both one of the most profitable financial company in India, and the fastest growing from profits perspective financial company in India.
When you say the most financial company in India, what is the benchmark?
So if you look from an ROA perspective,
Okay.
right, they have the highest ROA of any financial company in India.
What is
Right.
their ROI?
It's as of last quarter, it's 8.8%.
Wow.
It's really in a different league altogether.
I
And-
think for SBI it's less than 1, and for HDFC Bank is about 2.
yeah.
So
that's
this is
for
a
comparison.
phenomenal number. This is
Yeah,
phenomenal. I'm just
right.
putting the number out for the benefit of our
Yeah.
viewers.
And
The ROA of SBI is less than 1, and HDFC Bank is almost 2.
Yes.
This one is 8.
8.8 as of last quarter. When we invested in them about 3.5, 4 years ago, they were at 6% ROA. And our base case was that it would probably moderate out, right? And since then, pretty much every quarter, they've continued to inch it up because it's a business that has limited competition in the south. There is competition, but it's limited. But really the differentiation is in terms of their supreme asset quality. This company, since inception over a decade plus ago, has had hardly any write-offs or loss given default. That's supreme underwriting, right? So if your credit costs are low, your spreads are fairly wide, and your operation costs as you keep growing continues to come down. So when we invested, their OPEX to AUM was north of 4%. Today is in about 2.5%, and it slowly continues
What
to come
is the
down.
book value?
See, the book value, from a price to book value, it looks expensive, right? It's about 4.5 times. But, this is a company that over the last 5 years has grown its earnings at 58% compounded, right? Last 3 years at 48% compounded. Last 1 year at again 47%, right? So it's a very fast growing earnings company.
It's like Growth Finance 10 years ago.
It's like Group Finance 10 years ago, right?
It was always expensive, but their low NPAs and the spreads one of the highest.
Exactly, right? And this company, if anything, has better ROAs and better growth than what Group Finance had 10 years ago, right?
The challenge is that the housing market now is a market where the big boys, they really want to dominate the market share. Their access to capital, which is the reason why they enjoy the spread, is actually much more efficient. So when it comes to mid-tier housing finance company, what is the moat? What is the USP?
I think that's a great point, right? Which is that you do not want to compete head-on with the large banks, right? And in our past experience of 15 years of investing in many non-banking financial companies is that only time when they really excel is if they're on a turf where the banks cannot really compete with them, right? And so the prime housing, right? So if you're looking at home loans for people like you and I, or people are employed at sort of high quality corporates, everybody is competing over themselves to lend to them, right? And in that environment, you can't compete with the likes of SBI or HDFC Bank, right? But when you come to self-employed, affordable housing, right? So Aptus's average loan value is 9 lakhs.
Oh, that's it.
That's it. At that price point, no bank can profitably
Like a
lend.
microfinance home finance company. If
Yeah,
I
the
may have
only
to term
difference
it
is
this.
it's completely secured.
Yes.
Right? There's a real value in these housing, and most cases they actually lend at about 50% loan to value.
So these are beyond tier 2 actually. These are tier 3
Yeah,
home
these are
loans.
tier 3, tier 4, smaller places, but people are running good businesses, have regular income. It's just that, the banks don't probably see them as credit worthy because they've never had any experience with them. But in reality, they're actually extremely credit worthy. As you see sort of Aptus's and sort of other high quality value housing companies or affordable housing companies, that you find that their credit experience is as good, if not better than what the large prime lending housing finance companies have.
There's one very interesting thing which I've admired over the years in terms of investment style is that you look at the relevance of the business, that what will be the relevance of this business in today's disruptive world. And some of your bets in technology have really worked very well for you. I think Apple has almost been about 20x for you.
It's been a great investment, and it's only about 4 years ago. But it's it's the quality of the companies that continue to always outperform the expectations they've set. So when we first invested in Apple, Anuj would say, I can sort of commit to delivering a 25% year-on-year growth to you, right? Both in terms of revenue and profitability.
You went in the pre-IPO market.
So we invested while the company was still private,
Okay.
even before that filed the DRHP. And then we added to it during the IPO and later on.
You
So
still own Apple?
of course, it's a great business. Obviously, we've taken some profits off the table, because it was a large position to begin with, and with appreciation became even larger. But it's a company we still believe in. I mean,
I'm just going to give an anecdote to our viewers that when me and Sumit were talking about Apple, he said the most important real estate is the real estate which you own, and that is the space which I think Apple is trying to dominate.
I mean, they are the largest user acquisition company in India on the cell phones, right? And everybody wants to be on the cell phone. Everybody wants to have their app installed. Everybody wants to acquire users. And it doesn't matter which e-commerce company wins. It doesn't matter which food delivery company wins. They all have to pay a little bit of tax.
It's like a
to
toll
Apple,
tax.
right? So we
It's like a
that.
toll tax. Okay. Where else have you invested of late? Let's talk about some of the technology stocks, because that's where there is reasonable amount of fear and some degree of pessimism and perhaps a price advantage.
Yeah. So technology is a space that we like quite a bit, right? I mentioned before our first investment in India was in InfoEdge, back in 2008. So it's a sector that we like. It's something that I understand myself, having been an engineer. Yes. And so we like technology businesses. We've invested in a few, Apple that we just talked about. And many of the companies that went public last year, we sort of liked some of them. We had tracked them over the years. But just during the course of 2021, before these companies went public, there was such an expansion in their valuation and multiples that it no longer made sense to invest in them. So very grudgingly and reluctantly, we passed on all of them.
So no Zomato, no Policy Bazaar, no Paytm.
No, we didn't.
An absolute no to all of them.
So we didn't invest in them just because we thought the valuation was way ahead of themselves. And not that we would have predicted the way that valuation came in line, but that's the way it always happens. If the valuations are too high, eventually the public markets have a way of bringing them in line, either through time correction or through a price correction. And in this case, both are happening. And so eventually, I think some of them may become interesting, and so that could be an opportunity. But I think the other point that I want to highlight is that our mantra always had been to find companies that are profitable, cash flow generating. So even in technology sector, we have looked for companies like that. So Apple, when we first invested in, was already highly profitable, cash flow generating. IndiaMart was very similar. The two other investments in tech sector that we've made over the last 1 year, very dominant players in India, but incorporated outside of India.
Okay.
So one has been Truecaller, which I think everyone knows. Everyone has been a user of them. Again, highly profitable, highly cash flow generating business.
Where are they listed? I mean, we all know Truecaller, but I don't track it that much. Pardon me.
Yeah.
It's listed on.
It's listed in Sweden.
Oh,
right.
You can actually buy a Swedish stock listing in India.
So we can. I think for the global investors, obviously we can.
Okay.
For domestic investors, also we try very hard to ensure that they get access to such opportunities because they can't get allocations to companies like that. So second company which we invested in like that is Gupshup.
Okay.
And Gupshup, while the name is very colloquial, it's actually a very serious business. It's the largest enterprise communications business in India. And so every time, let's say you do a transaction and you get a SMS on your phone, it's through one of the enterprise communication
What about the
partners.
Desi market? What have you picked up from the Desi market? You're going abroad for shopping.
Well, so again, I just wanted to give an example of these technology companies that are highly profitable, cash flow generating. And both these companies, I mean, even though they're incorporated outside, they do 70 to 80% of their business and profits in India.
70 to 80%.
Yeah. So I mean, they are probably more Indian than, say, the IT services companies that are based here. So that's an example. In terms of opportunities in India, I think we look for things that are high quality, but where the valuations are reasonable, right? So things where the prices have become more attuned to fundamentals. So I gave an example of Wabo, right? Something that we own, we could add to. More recently, I think we've added in companies where you find very strong tailwind. So like Sirma, I think that's an electronics manufacturing company that's
I
about
think
to go.
IPO just opened right
Yeah.
now. 18th is when it closes.
Yeah. So again, solid business, very strong tailwind. I think everyone understands that electronics manufacturing has to slowly move to India. There's no reason to bump up our current account deficit by importing things that we can easily manufacture here. And so they're seeing huge demand coming in for local manufacturing here, but not only from the domestic customers, they're actually seeing very strong demand coming in from their export customers who are looking for this China.
So design manufacturing is what you're looking at.
Exactly, right? So high margin, so that's the difference. So they, many of the electronics manufacturing companies work on very thin margins.
It's a very interesting thing. Manufacturing moves from China to India. Look for companies which enjoy some degree of moat, and the business automatically comes from one pond to their pond now.
And so, so that's a value migration, very strong tailwind behind these businesses. We had seen this happening in case of, let's say, specialty chemical companies, a few years ago, and still playing out.
You do have exposure to specialty.
We do have. So that's an area that we like quite a bit. We made significant investments in them during 2020, and those seems to have sort of worked, very well. But it's also about looking for opportunities that may be a step away from that. So second order opportunities. So similarly, in case of specialty chemicals, we had looked at equipment manufacturers, right? So we had invested in HLE Glasscoat and GMM Pfaudler, two companies that benefited very strongly. Similarly, now that we're seeing electronics manufacturing taking place in India, we know that component sourcing will also become big. And as we looked at that, we found that in case of capacitors, there's only one company that produces this dielectric film, a company called as Xpro, which is a listed company. And so we infused primary capital in that company to expand their capacity to meet this increasing demand.
Why is that you don't analyze your investments based on traditional tools of value, dividend yield, enterprise value, cash in the book? Do you use those metrics to identify? Because if that is the criteria, then it should have been an NTPC or a Coal India or an ITC.
So see, we are investing to generate returns for investors over the long term. So we want to generate sort of far better returns compared to the market over the cycle, let's say over 5 years, 7 years in that time frame. And so in that time frame, you need to look for opportunities that can deliver that intrinsic value growth, which in most cases have to come from earnings growth. And while some of these names that you mentioned are safe investment, they're cash flow generating, but they're not going to compound their internal earnings or intrinsic value at the rate that we're looking to underwrite.
So what's your yardstick, 20%?
So we look for at least 20%, more like 25%.
That's the top line growth.
That's the bottom line growth.
That
we're looking at. But in most cases, it's driven by a very strong top line growth and at least sustained, if not improving margins. And as a result, sort of improving return ratios, so ROE, ROC. So those are the fundamentals that we look for. And the focus is on the long term, right? So the best examples are when there's a short-term pressure, which leads to valuations coming off. So like Wabo that we talked about.
Buy a good company when it is going through a temporary disruption. The value of the terminal franchise will be unlocked going forward.
Exactly. Right?
So that you see happening right now in technology and names like WebHub.
Yeah, so it's happening there. It's happening in some pharma names as well.
But that's not happening in banks. Then why are you buying banks? I mean, if you're buying, let's say, a housing finance company at a price to book of 4 times, that makes it a stock which is more expensive than HDFC Bank, which is considered to be gold standard.
Yeah, but it's a company that's today on trailing basis is at 30 times trailing earnings. Okay. If from this year's number is probably 25 times earnings, and it's the fastest growing company in that sector. And as their leverage increases, and given their ROA, they have the ability to generate 25% plus ROE over the long term. Very, very few financials in the world have the ability to do that. And once they do, they actually get rewarded very well by the financial markets.
That's what you're looking at spotting. Look at the combination of number, potential growth, and one day the real P re-rating or value unlocking will happen.
That will happen, right? The markets are very smart, right? And they get things eventually right. And so that's what we bet on.
Typically, you look at a company or a business which is at an inflection point, or there is a market share gain, or there is a big expansion in terms of the size. Where do you see the big size of the pie growing? Because if the size of the pie grows, everybody benefits.
Yeah, so I think the examples that we talked about, right? So whether it's affordable housing finance, I mean,
that's one theme, affordable
it's very
housing.
minimal penetration across the country, right? So I think the pie will keep growing there. We talked about electronics manufacturing. The pie is growing rapidly, right there. You talked about specialty chemicals, exactly the same thing, right? So, so these are all the areas where the pie is growing, very strongly. But if you find a good player within that, that still has the ability to gain market share and to grow faster than the industry, right? So we like companies that have strong tailwinds, right? So let's say an Apple, it's enjoying the 30% growth that mobile advertising is seeing in India, but it's consistently able to outperform that, right?
The India of last 10 years versus India of next 10 years would be different. Everything would have an interplay of digital, so to speak. We've been very stock specific, even though you mentioned that you've been owning some stocks and you're looking at investing. Let's talk about a disclosure.
As for disclosure, all the companies that we talked about, we either own them today or we own them in the past. So that way, we're vested interest. But we feel very strongly about these companies, and we talk about the fundamentals. Every investor should just look at the fundamentals and come to their own decisions.
Well, you've given fantastic returns to your investors over the years. Keep up the good work, and certainly hope to see much more of you going forward, and hope to see much more of you going forward in our studio. So nice and warm to interact with you live in person.
Same here. It's been a pleasure, and hope we can do more of this.
Thank you very much. For the moment, I'll just give it back to Nenta Rao, and she's got news on Mahindra and Mahindra.
Right, Nikunj, look at the M&M share price continuing to drive in the fast lane, higher by nearly 2%. So far, we've been talking about the new Scorpio, the kind of, bookings it has seen, breaking all kinds of records. But Anand Mahindra in London to talk about the company's EV plans going forward. After garnering almost a 70% market share when it comes to three-wheelers, M&M has unveiled as many as 5 SUV designs for EVs. Remember, its EV arm has got a valuation of more than $9 billion. Here's Dr. Anisha of M&M in conversation with my colleague Sumeet, who traveled all the way to UK tracking that big EV launch.
Pricing, Sumeet, will always happen closer to the delivery time. But all I can say is if you look at what we've done with the Thar, with the XUV700, with the Scorpio, it has been a very compelling value proposition at a very compelling price. And that is the approach that we will follow with these vehicles as well.
Okay. With EVs expected to be around 20 to 30% of your entire SUV portfolio, where do you see your margins to be? Will your margins increase as EV cars come more into your portfolio? So will EV car margins be higher compared to what current margins are for the company?
So at this point, we are expecting margins in auto to go up 300 basis points. That's something that we have talked about. And for EV, we would expect them to be consistent with other models at this point in time. I think as we get closer to the date of delivery, we will have a better sense. As these start moving in production, we start looking at what pricing can be offered in the market. But our expectation right now is at par with what we have.
Okay. Anand Mahindra in his speech, let's say that they are planning to going big with EVs globally, and not only in India, but globally you're planning to launch EVs. So which foreign markets are you considering, and will all the cars that you're launching will be first launched in India, or will it be a simultaneous launch in the export market as well?
Our first port of call is to make sure that we can fulfill demand for XUV700 and Scorpio N. As we launch these cars, we will go global because we are competing with the best in the world in India today, and we want to compete in global markets with them as well, and we know that we have the cars to do that.